Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Desarte Yarnway, Financial Advisor at Yarnway Wealth Management and also Head of Community at Altruist. We have Eric Diton, President and Managing Director of the Wealth Alliance. And finally, Timothy Chubb, Chief Investment Officer of Girard, a Univest Wealth Division. They are joining me to discuss the pillars of smart investing. And this includes investment strategy, security in investing, and the Custodian. Gentlemen, it's great to have you with us. Welcome to Trade Talks. Let's go around the horn here. Desarte, will start with you. Tell us where you sit within the wealth management space.
Yes, I'm an advisor, as you mentioned, for Garner Wealth Management, but I am the head of community at startup Custodian Altruist, and I'm happy to be here today, Jill. Thanks for having me.
All right, it's great to have you back as always. And Eric, if you could tell us about the Wealth Alliance.
Sure. I believe I'm the old man in the group here. I am a president and co-founder of the Wealth Alliance. Been a financial advisor now for over 38 years, basically right out of college. We manage close to $2 billion for high net worth investors, and we love every minute of it.
All right. Well, certainly you always want the diversity of experience on these panels for sure. And finally, Timothy.
Hi, Jill. Yes, I'm the Chief Investment Officer of Girard. We manage about $5 billion for a whole host of clients everywhere from private wealth relationships to multifamily office, pensions, and a little bit of everything in between.
All right, and let's get right into this. Desarte, when you think about investment strategy, you and I have discussed before that it's not simply about growing the portfolio, but there is purpose attached to that as well.
Absolutely. One of the things that I like to say, advisors are investment counselors, which means that you have to do a little bit of both, right? So when we think about investment strategy from the client's seat, I really want clients to align themselves with their purpose. So that means really digging in, seeing how they want their money to connect, right? And being able to create a financial strategy that meets those goals.
Right. And of course, Eric, having a process in place is just as important too.
Yes, I think it's really important to get inside that client's head. What makes them tick? What is it that they're really trying to accomplish? And we just spend an enormous amount of time just sitting around a table, asking questions, taking notes. And ultimately, the goal is to get enough data so that we can run an analysis and just show that person in black and white, based on all these assumptions that we made together, are your goals realistic? If they are, that's great. And if not, what changes do we need to make so that you can get where you want to get to?
And Timothy, what about covering the basics of building an investment strategy?
Yeah, I mean, I think it always comes down to diversification and ultimately trying to decide what that suitable asset allocation mix is. Using diversified ETFs, mutual funds, individual stocks and bonds, and really try to understand what that preference is for the client to personalize something, as Eric had just mentioned. But I think as he also commented on really importantly, a lot of that fact finding exercise, as we're trying to determine what that proper asset allocation mix is and alignment with the goals, and of course always keeping into consideration withdrawal order and asset location. Is really the behavioral coaching element of what we do. And ultimately, this is a really emotional, thing, talking about people's, financial health and savings and what they've worked so hard to help, grow and set away for retirement. And then trying to understand, what those pain points or triggers might be for a client from an emotional standpoint, whether it's market volatility or geopolitics, to really provide that behavioral coaching to prevent sort of the best laid wealth plan from being disrupted by a knee-jerk reaction.
Yeah, and Eric, it seems to be the consistent theme here is coaching among the three of you.
Yeah, I have found one of the most difficult parts is really understanding how much risk that client is comfortable taking. So the traditional way of asking is, are you conservative, conservative to moderate, moderate to aggressive, or aggressive? Well, you can have 10 people in a room that say moderate, and what's moderate to one person can be completely different than what's moderate to someone else. So we always go to the next level. What we're really worried about, of course, is downside risk. No one ever complains when things are going up, but they get nervous when things are going down. So I like to get right to it and ask, okay, you have this $1 million, for example. What if it were to drop 10%? And I say 10%. $1 million to 900,000. Are you okay? Can you sleep at night? Can you stay in the plan? Yes? Okay. What if it went $1 million down 15% to 850,000? And we keep going until we hit that pain point where that person says, okay, if it dropped by that amount, I would not be comfortable. That's what we need to know. Now we can go back in history and put together different allocations that haven't violated that. And that's really a differentiator I found over time, is really getting inside that person's head.
Right, Timothy, and I'll get to you in just a moment here, but Desarte, I mean, you note this, a very similar sentiment about educating the client before even making the asset allocation in a portfolio.
Absolutely. I love Eric's kind of frame of mind, right? Because I think that advisors often try to jump to the technical aspects of the job before getting in the minds of the clients and having personal finance be personal. This is their money. They've worked so hard to build up this next eggs, right? So we need to take as much time as they have to kind of build this up to really see how we can best serve them. Sometimes that's just getting them comfortable with the idea that the market does come with risks, right? Sometimes that's getting them comfortable with volatility, getting them comfortable with some of the investment options that Timothy mentioned. So I think it's almost more critical, right, to go through those exercises before implementing any sort of plan.
Right, and Timothy, your thoughts?
Yeah, I agree completely. So much really falls on education, understanding, different types of assets, why they're in the portfolio, how they're going to be rebalanced, and how to stick to that, discipline plan over the long run. But, I think before you even get to that point, Eric brought up something, that, we talk a lot about. It's sort of the risk tolerance and how much pain can you, handle. And unfortunately, a lot of advisors out there have sort of a prescriptive way of doing that I think ultimately doesn't necessarily take into consideration just how different pain is when it comes to investment losses for different clients. I pick stocks, it's a portion of what I do. And so, volatility is really, a function of permanent loss of capital. But for our clients, it's not that easy. And so, when you ask on a scale of 1 to 10, what your risk tolerance is or how much you can necessarily experience in a drawdown without getting upset, it's kind of like going to the hospital and they ask you, how much pain is your knee in, 1 to 10. Everyone's going to have different pain tolerance. That number is going to be very different from each person to person. And it's also important to, understand that sometimes, some pain is necessary to get to the goals that you're trying to reach. And so going through that education process, it's not just about the investment strategy that's important. It's how that investment strategy works in concert with, a really well prepared, wealth plan that can be updated over time. And making sure that the left hand is what the right hand is doing.
Right, and Desarte, to Timothy's point, right, it's not a one-size-fits-all solution.
Absolutely. I think we overuse this buzzword risk tolerance a lot in our industry, but really we should be talking about risk preference. And using that as a starting point, we can back into the likelihood that a client is going to reach their goals or not, depending on their risk preference, right? Like we've all been on an airplane before. I love a smooth flight, but I can tolerate turbulence, but it's not my choice, right? So if we start with risk preference, then we can get a better understanding of what the client wants. Is it more aggressive portfolio, more moderate portfolio, conservative? And then we can kind of do the numbers, the fact finding, the projections, as Eric mentioned before, to build them a plan that meets that preference or close to it.
Right, and Desarte, let's switch gears for a moment. Now I want to talk about security in investing. It's one thing to feel safe about your allocations within a portfolio, but how do investors know that their investments from a structural perspective are safe?
Well, first and foremost, choosing an investment advisor is going to be important. Investment advisors are fiduciary and have a legal interest to put your interest first of the client. Number two, I would say a custodian, right? Obviously at Altruist, we're on a mission to make financial advice better, more affordable and accessible for all. And choosing the right custodian can help you, track your assets and keep things organized.
Right, and Eric, being the senior in the group here, as you had alluded to, I mean, you've seen how it's evolved with regulators and how they're constantly working for the investor to create a more safe framework.
Yes, I mean, it's interesting because years ago, in the early 90s, I worked at Lehman Brothers, and many years later, Lehman Brothers went under. And the good news is that there are no investors that lost money because they held their assets at Lehman. Despite the fact that Lehman went under, regulators made sure that when those markets opened Monday morning, Barclays Bank had taken over custodianship of those assets, and those assets were safe. And that's where regulators play a very big role in protecting investors from calamities like the financial crisis. So I think they do a great job. We just, I worked at a major wirehouse and we started our firm 4.5 years ago. And we did do that custodian search, and that is huge. For us, we ended up at Fidelity. One of the things I loved about Fidelity was when many of the big banks needed a government bailout in 2008, 2009, they didn't. Why? Well, they're privately held. They're held by a family that didn't take those risks. And that was important to us.
Yeah. Well, Timothy, it's so interesting when you think about selecting an investment advisor, or if you're doing your own self-directed investing. I certainly don't say, I feel like I'm speaking for retail investors. I don't think about the custodian, but it sounds as if this is one of the most crucial decisions that advisors have to make in terms of who they align themselves with when it comes to selecting custodian.
It certainly is. I think we often have, prospective clients actually do a little bit more of a deep dive than many others, and it's something that we sort of welcome to help really educate them and help them understand just the level of due diligence. To your point, that it really goes a firm like ours would go through in selecting custodian. And it's everything from just the reputation, the financial stability, as Eric and Desarte had mentioned. Of course, there's fees and cost transparency. That's really important, as well as just the quality of the experience. Do you like the website? Do you like the mobile app? Everything from cybersecurity. And so it really requires a comprehensive evaluation on the part of the advisory firm. And I also think it's useful to have multiple options at the disposal of an advisor, if there's particular client preference that ultimately is not being met by one custodian, to have an alternative to really show that fiduciary strength of we certainly are trying to put your interests first and foremost, and have something that really caters to ultimately clients that have some of those values that may be different from one another when it comes to selecting a custodian.
Right. Well, Desarte, from a custodian's perspective at Altruist, what are you doing to differentiate yourself, and how are you working with advisors and investors?
Well, absolutely. Before I get there, I think Timothy hit on some good points, right? I think every client should be asking their advisor, how do you work with your custodian, right? How is that going to impact me? Are there additional fees that I'm going to incur because you decided to select an Altruist or another custodian, right? How's the user experience? Is your custodian in competition for your clients, which some custodians are, and they make proprietary products to sell directly to your clients, right? These are all important questions that at the end of the day will impact your clients. In terms of what Altruist is doing, obviously we have the world's fastest account opening process. It's a fully digital custodian. Open account transfers everything within minutes. And I think that helps both the advisor and the client have a better user experience.
Yeah. Well, that's interesting. I didn't realize that custodians do compete with advisors in terms of competing for the same clients. Am I understanding that correctly? I thought they kind of had to separate the two of those.
I mean, there's proprietary products, right, that custodians will love advisors to use. That's ultimately going to benefit the custodian. And there are other proprietary things that custodians are doing all the time to sort of make money on the clients, right? Cash balances, things of that nature, right? So I think when you really get into the inner workings of the custodian relationship with the advisor, it's important that the advisor discloses some of these things to the client, and they make sure that it's understood and just transparent overall.
Yeah. Eric, when you think about how the RIA space is changing rapidly, right? And how advisors are leveraging newer technologies to free up that time so they can have a more empathetic relationship with their clients, right? That's really, what they want to be doing, and kind of move away from so much of the back office work. How do you see the space continuing to evolve?
Well, it's a great question. It's interesting. First of all, there's a tremendous amount of consolidation. So RIAs are getting bigger and bigger, and they need to offer more services. First of all, we touched on cybersecurity before, and I just want to say that is a huge, huge business. It's a huge concern. My custodian has, I think, something like 900 people just focusing on cybersecurity. To give you an idea of just what a big problem. I mean, I think today, AT&T said they had a big data hack. So I think that's one of the biggest concerns. I think technology, I know our custodian is constantly bringing out new ideas, new ways for customers to interact. We're working on a portal where clients can bring all of their major documents, store them, be able to access them in one place. If something happens to the client, their heirs can get to those documents. So things like that that are just going to make the client experience better. That's constantly just evolving.
Yeah, it certainly is. And Timothy, also same question for you as well. In fact, we just wrapped up another panel on the future of wealth management as it relates to AI and leveraging these other types of new technologies and storing data. And cybersecurity was a big part of that conversation. How do you see this continuing to evolve?
Yeah, well, I think one of the major things that we try to impress upon our clients ultimately is, there's the custodial relationship that you have. Of course, we're trying to always influence or educate on how we have our internal processes, how the custodian has their internal processes, and doing something like a third-party wire. What the steps, hoops, and hurdles are, to go through something like that. And I think really illustrate just how secure and the focus on regulation and security that ultimately not just the custodial is prioritizing, but us as well. And so what those processes look like are obviously extremely important from a cybersecurity standpoint, beyond just the technical aspect of prevention. It's also the qualitative element of it too, so that you're not having say an advisor get an email from a client that's ultimately been hacked, and then next thing you're sending money to and getting signatures from somebody who's bad actor. It's about picking up the phone sometimes at the end of the day and making sure that that request is actually valid. But as far as the evolution of custodians, I think to Desarte's point, ultimately there's quite a few that are competing with firms like us, and I think it's ultimately been a benefit to the industry in the context of really offering low-cost, accessible portfolios to clients at really that are just starting out investing. I think a lot of those solutions, baseline wealth plan, baseline investment portfolio that's highly diversified and low cost, or something that those custodians can offer very well for some of those small relationships. But really, as you evolve, your financial picture becomes a bit more complicated and nuanced, or perhaps you have some specific preferences and values that you'd like to see expressed in the portfolio. That's really where sort of going and getting that cookie cutter portfolio and cookie cutter wealth plan that again are very inexpensive and really well designed for that new investor ultimately to take another step and maybe pay a little bit more, but ultimately getting the benefit of having such a comprehensive valuation review of things and the ongoing point of contact that a lot of clients are looking for as their financial picture begins to get just a bit bigger and a bit more complicated.
Yeah. Desarte, do you think the industry itself is doing enough to attract the next generation of advisor? And we have the massive wealth transfer that's probably happening right now, right? But the growth in terms of advisors coming on has been relatively stagnant. Is the industry doing enough? Do you think with the advent of incorporating more of these emerging technologies might be more attractive for the next gen advisor to come on?
Absolutely. I think we do a great job of trying to attract the next gen client, not so much of a good job trying to attract the next gen advisor. And as investing becomes something that is widely accessible, I think that we have a great chance at getting more advisors to kind of join the industry, express their interests. I mean, before the show came on, Eric talked about how he was on a pre-med track before getting into finance, right? So we're in a place right now where we'll begin to attract more advisors because of the technology, it aligning with sort of the day-to-day things that we see young people using, their phones, right? Mobile applications and things like that should be helpful in us hopefully growing the industry from a professional perspective.
All right, and we'll leave it on a positive note, gentlemen. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.